Hello and welcome to Module 2 of the SWC/UST Masterclass. And this module is going to be on the topic shares and dividends. This topic is specifically chosen because the opportunity of UST is the opportunity to buy the pre-IPO shares of this company. And before you begin to talk about buying shares, you need to at least know what shares and dividends are all about. If you haven't already done so, please subscribe to this channel, turn on the notification bell and hit the like button so that you will be making the YouTube algorithm send this video to more and more persons who may find it beneficial. Alright, so let's get right into the video. And before we do, I'd like you to remember that the content of this video is for educational purpose only and is not intended as investment advice. Make sure you do your own research and check with your financial advisor before you make any investment decision. Now, what are shares? They are a unit of ownership in a company or a financial asset. Investors who hold or own shares of any company are known as shareholders. For some companies, shares also exist as a financial asset, providing for an equal distribution of any residual profits of the company if they are declared in the form of dividends. Shareholders of a stock that pays no dividends do not participate in distribution of profits. Instead, they anticipate participating in the growth of the stock price as the company profit increases. Now, we'll be looking at type of shares, and there are several categorizations depending on the factor under consideration. If you were to categorize shares according to possibility of the shareholders partaking in the company's profit sharing, then we have two types. Dividend shares, which allows the holder to profit both from the company's profit sharing and the increase in price of the share unit on the stock market, and non-dividend shares, which allows the holder profit only from the increase in price of the share unit on the stock market, but does not give room for investors to participate in sharing the company's profits. That is the dividends. Now, so we have share price appreciation and passive income you can get through shares in the form of dividends. When you categorize shares according to the time or the stage of the company's development in which they are sold, then we can have three categorizations. Number one is pre-IPO shares, then we have IPO shares and post-IPO shares. Pre-IPO shares are sold during the pre-IPO of a company's development. IPO means initial public offer. So pre-IPO means before IPO. It's important to note that before a company's public offer, that's IPO, most companies must have already offered their shares for sale privately to individual investors, banks, or other organizations in the form of a pre-IPO sale. Companies selling pre-IPO shares do so in order to raise capital to facilitate their development. So pre-IPO investments are usually venture capital projects with a very high discount. This is usually the cheapest time to buy a company's shares. It equally has a high amount of risk, and the risk here is that the company may fail to develop to the point of IPO and listing of their shares in the stock exchange market. As such, the high discount on a pre-IPO share is intended to compensate investors for the risk they are taking, because this is the riskiest time to invest in a company. It is also the cheapest point at which you can buy a company's shares. So the keynote here is it is very cheap when you buy a pre-IPO share, but it is also very risky. IPO shares are sold during the initial public offering of a company's shares on the stock exchange market. In order for a company to go public on the stock market, they must be able to show evidence of profit over a number of years. Now, when they are granted entry into the stock exchange market, the pre-IPO shareholders, those who have already bought pre-IPO shares, can then sell their shares either all or part of the shares that they bought on the stock market for a higher price, or they can wait for the price to increase further before they sell. It's important to note that buying a company's shares at the IPO stage is usually more expensive than buying at the pre-IPO stage. Also worthy of note is that people who hold dividend shares may wish not to sell their shares, as dividend shares gives its holders the right to receive a proportional share of the company's profit every quarter in the form of dividend payment, which is a residual income. Most companies pay quarterly, so that is every 3 months. Lastly, we have post-IPO shares. Now, after the initial public listing of a company's shares on the stock market, the share price are affected by factors such as market variables, but the greatest of them is the factor of demand and supply. Now, if a company is profitable and the company's shares are seen as valuable, demand for those shares will rise and the supply will fall because shareholders will be unwilling to sell their shares. So this will lead to a demand-driven inflation, leading to higher prices. However, if a company is seen as not profitable, many of its shareholders may sell their shares, leading to an increased supply of the shares and a low demand, which will eventually result in lower prices or falling prices. So we can categorize broadly into startup phase, growth phase, maturity phase, which is the pre-IPO phase, the IPO phase, post-IPO phase, which is the growth phase as well, and then public maturity. Now let's illustrate the type of shares using Zoom communication. In 2015, Zoom sold its pre-IPO shares for 30 cents per share, and they reached out to high net worth individuals to invest into their startup. Now this is a former governor of Anambra State who was approached by Zoom in order to prospect him to invest in their company. Now he was recounting this experience during a Zoom webinar where he said he was telling some people a few days ago how he met some persons who told him about Zoom shares in 2015 and asked him to invest. At a time it would have cost him 30 cents to do so. All right. So Zoom's initial public offer was announced on the 18th of April 2019 at a staggering $62 per share. Now that represents a 20,666% price increase as against their pre-IPO price. Zoom Communication experienced an all-time high in their share price of $559 per share on the 16th of October 2020 during the COVID-19 lockdown, representing another 902% price increase as against the price when they were listed in their initial public offer. So you can see that information on NASDAQ. So I'm just going to pull that information up. You can see Zoom current value, but then if we look at this chart and look at the max trend, we'll see that at this point here, when they were listed on the 18th of April 2019, they entered the market at the price point of $62 per share. And at this point here, on the 16th of October, they were trading at $559 per share. Today, they are trading at $109 per share. Now, to illustrate, Zoom shares are also dividend shares. And if you check this screenshot attached here, you can see that for the third quarter of 2021, they announced their EPS, earnings per share, at $1.01. That means if you hold these shares, you would have earned $1.01 for every single share that you hold as dividends for this third quarter. So let's just go back to the financials. Okay, let me slide back. Let me just pull back the financial records that I pulled up earlier. and let us go to financials and pull up this information. Now, when you go to quarterly financials and you check the EPS, as at the third quarter of 2022, they reported a $1.03 earnings per share. So that means if you hold shares, you will be getting, for every share you hold, $1.36. If you were to open this information on this website here, where I pulled up this record, if you were to open this information on this source, you would see the information here on Zoom Financials carries an EPS of $1.01 per share. Okay, so quarterly financials, and let's just go to earnings. This is reported for $1.01. So the data in this website is a bit different from the one we just looked at, but the idea is Zoom pays dividends for shares you hold to shareholders who hold those shares. So you don't profit only from the price appreciation, you equally profit from residual income paid in the form of quarterly dividends. Let's move on. Now let us do a potential profit analysis. And let's start with the question, how profitable is it to invest in a pre-IPO? Now, still using Zoom as our illustration, in 2015, when Peter Obi had the opportunity to buy Zoom pre-IPO shares at 30 cents per share, $1 was 198 naira. So assuming he had invested about 500,000 naira, at the exchange of 198 naira, 500,000 naira would give him 25.25 in dollar. That is $2,525, which at the price point of 30 cents per share would have been able to purchase 8,417 Zoom pre-IPO shares. Now, as at 16th of October 2020, when Zoom hit $559 per share, as you can see in the attached picture by the right of this slide, the same year, 2020, $1 was 380 naira, and 8,417 shares would have been worth $4,705,103, which is approximately 1,787,939,140 Nigerian naira. Note that this does not even factor in dividend payment. This just shows you the price appreciation from 2015, when the shares were 30 cents per share, to 2020, when they were $559 per share. Assuming Peter Obi had invested 500,000 naira, his 500,000 naira investment would be worth 1.7 billion naira, almost 1.8 billion naira. So this is factual. As you can already see the data, everything adds up. So imagine how profitable it is to invest in a pre-IPO. You can no longer invest in the pre-IPO of Zoom Video Communications. And Zoom did not approach you to invest in their pre-IPO because they sought out high net worth individuals. Now, there are three ways companies finance their growth: either by taking loans from financial institutions and paying back with interest, or reaching out to angel investors or high net worth individuals to invest in their startup and selling their shares to those people, or crowdfunding. So if a company takes either of the first two approach, they will not reach out to the general public and tell the general public about their business idea. But if a company chooses to crowdfund its startup, then you will be able to hear of that opportunity to invest in their startup in the form of purchasing their pre-IPO shares. Now, head over to module 3, where we'll be talking about Unitsky string technology, the ultimate transport solution, a company that has decided to crowdfund their idea, which is a revolution in the world of transportation. Just as a reminder, if you haven't already done so, like this video, subscribe to this channel, and turn on the notification bell. My name is Bossey, and I'll be seeing you in the next video. Thank you.